Are you wondering if the Fed's 2025 rate stance will tank your portfolio or spark a massive rally? I was shocked digging into the latest data, tariffs, inflation, and a cautious Fed could flip markets upside down. Let's dive in. Today, we're tackling a big one. Will the Federal Reserve's 2025 moves trigger a market boom or a bust? We'll dig into fresh data from the past month, like JP Morgan's May 11th report. Hit that subscribe button and let's get started. All right, let's set the stage. The Federal Reserve has kept the federal funds rate at 4.25% to 4.5% through May 2025, pausing after 3 cuts in 2024 that dropped rates by a full percentage point. Fed Chair Jerome Powell, in his May press conference, called it a wait-and-see approach. Why? Inflation's stuck at 2.8%, above their 2% target, and economic growth is holding up. Think 3.1% annualized GDP in Q1 per the Bureau of Economic Analysis. But here's the kicker. The Fed's March 2025 projections slashed expected rate cuts to just 0.25% moves this year, down from 3. JP Morgan's May 11th report backs this, saying cuts won't hit until late 2025 because consumer spending, like April's 0.7% durable goods spike, is still strong despite softer sentiment. The Fed's walking a tightrope, curb inflation without killing growth. So, what does this mean for your portfolio? The S&P 500 climbed 4.2% in May, fueled by killer Q1 earnings. Think Nvidia's 20% profit jump. But U.S. News warned on May 29th that a reluctant Fed plus tariffs could spark a 15% correction. Trump's April tariffs, like 10% on Chinese goods, are stoking inflation fears. EY's latest forecast predicts real GDP slowing to 1.3% by Q4 2025. That's rough. But hold up. Morgan Stanley's February outlook says AI-driven productivity could push S&P 500 returns past the typical 5% third-year bull market average. I was floored when I saw April's durable goods spending jump 0.7%. Consumers are front-loading before tariff costs hit. So, boom or bust. It's a coin toss, but volatility's coming. Let's zoom out globally. Europe's central banks, like the ECB, are planning multiple cuts in 2025, per Bloomberg's January report, while Japan's hiking rates to fight yen weakness. The US dollar's still a safe haven, even with recent dips, thanks to the Fed's hawkish vibe. So, what should we do? JP Morgan says watch CPI and jobs data. May 13th's CPI report showed sticky 2.8% inflation. Here's where we get spicy. I think the Fed's hiding a bigger worry: stagflation, high inflation, slow growth. Deloitte's 1.3% GDP forecast for Q4 screams trouble. If tariffs jack up prices and growth stalls, markets could crash, not boom. Smart investors here don't chase AI hype blindly. They focus on fundamentals. Morgan Stanley highlights healthcare and utilities for strong balance sheets. That's it for today. The Fed's tightrope walk could tip markets either way, so stay sharp and diversified. If you found this video helpful, smash that like button, subscribe, and ring the bell for weekly stocks and crypto insights.